Hello, everyone, and welcome to our exciting lecture series on managerial accounting. And I'm your teacher or instructor, Jamal Haider. And today we are starting a brand new chapter. I can't wait to start, so let's start. In chapter 13, which is relevant costing for decision making. So we know that making decisions is one of the basic functions of the manager. To be successful in decision making, managers must be able to tell the difference between relevant and irrelevant data. Right? And they must be able to correctly use the relevant data in analyzing alternatives. So the purpose of this chapter, chapter 13, is to develop these skills by illustrating their use in the wide range of decision making situations. So I'm not going to take more time, I'm going to move forward. So our learning objective 1 is identify relevant and irrelevant cost and the benefits in a situation. So let's talk about cost concept for decision making. We have relevant cost. A relevant cost is a cost that differs between alternatives. For example, we have A option and B option. So for example, our cost here is A is 10,000 and B is also 10,000. And for example, salaries here 5,000 and here 2,000. So which one is relevant? Only 3,000 is relevant. Why? Because costs are the same, so they are irrelevant, because whatever option we choose, cost is the same in both alternatives. So here salaries differs, right? 5,000 and 2,000. So in that case, the relevant cost for decision making is that differs between these two alternatives, that is 3,000. So our learning objective 1 is identify relevant and irrelevant cost and the benefits in a situation. So the cost concept for decision making, so one is relevant cost, which is a cost that differs between the alternatives. For example, we have option 1 and option 2. For example, here we have cost 10,000 and we have salaries 5,000. Here the cost is also 10,000 and salaries 2,000. So again, I'm going to repeat the definition. A relevant cost, the cost that differs between alternatives. So here it is. So does this cost differs in these two options? No, that's not relevant. So salaries, it differs. Yes. So the difference is how much? 3,000. 3,000 is our relevant cost. So let's move on the next slide. Our next slide is identifying the relevant cost. In order to identify, let's understand the concept of avoidable cost. So avoidable cost is a cost that can be eliminated in a whole or part, full or half or in part, by choosing one alternative over another. So avoidable costs are relevant. Remember, avoidable costs are relevant costs, whereas unavoidable costs, they are irrelevant cost. So in our previous example where we have option 1 and option 2, so 10,000, these costs are unavoidable, right? Unavoidable, which means in either cases we have to incur these costs, so these are not relevant. So avoidable, in our previous month's salaries, like option 1 and 2 we have 5,000 and we have 2,000. So if we choose 2 we can avoid 5,000. If we choose 1 we can avoid 2,000. So in that case these are avoidable costs. So the two broad categories are of the cost that are never relevant in any situation, in any decision. They include sunk cost. And what is the sunk cost? A sunk cost is a cost that already been incurred and cannot be avoided regardless of what managers decide to do or not, right? So it means it's already sunk, drowned, you cannot recover that one. So in other cases the sunk cost is always irrelevant. So what are the examples of sunk cost? For example, legal fees, right? For example, you want to pay for your lawyer the legal fees. So the legal fees is whatever the court verdict is in your favor or not, you have to pay the legal fees. So legal fees is sunk cost, and that those costs that do not differ between the alternative. So we have decided like here, they do not differ, so these are also not relevant. Now how are we gonna identify the relevant cost? So we have relevant cost analysis, a two-step process. So the first step is to eliminate costs and benefits that do not differ between the alternatives. So it means you segregate the alternatives and you want to find out those benefits that do not differ, which means those who are not the same. So you identify those alternatives, those costs, those benefits, and the step 2. But regarding the step 1, so in this case you do not include the sunk cost and all those costs that do not differ between the alternatives. The previous slide, two broad categories were just discussed, okay? And now the step 2 is to use remaining costs and benefits that differ between alternatives in making the decisions. So here the costs that remain here are differential or avoidable costs, or the difference like we just discussed in our option 1 and 2, salaries, option 1 5,000 and option 2 2,000, right? So it means that the differential cost is 3,000. Sorry about my writing. Okay, so we successfully managed the steps. Step 1, you identify between relevant or irrelevant or avoidable or unavoidable stuff. You gather the information, and then on the remaining one you do your analysis on the basis of avoidable and differential cost. Okay, we have a question in which we talk about identifying the relevant cost. So assume the following information with respect to Cynthia, a Boston student, which is considering visiting her friend in New York. She can drive or take train. Now we have two options. We have drive or train, right? Car or train, right? So now by car, you see, it is 230 miles to her friend's apartment, and she is trying to decide which alternative is less expensive and has gathered the following information. So we know that the annual straight line depreciation of the car per mile, we have cost of gasoline per mile is 0.1, annual cost of auto insurance and license, this is the annual one, and the per mile is 0.138, Maintenance and repair, we know that is given is 0.065. Parking fees at school is $360, and that is annual one, so this is per mile. So total average cost is 0.619. So do you think that all the costs inside this 0.619 are all relevant? Of course not. Some costs are avoidable and some costs are unavoidable. And whose cost is relevant? The avoidable cost is relevant cost. So let's explore this example further. So how this depreciation is calculated. We know that she purchased this car for 20,000 and she can sell it at 10,000 after 5 years. So you divide it by 5 years, answer is 2,800. So that is also a simple straight line method of calculating depreciation. I hope you already learned it in your principles of accounting. So also this parking fees 45 per month, 8 months left, so you just multiply by 8, 360. These all information are given. Okay, so let's move further. So different costs for the different purposes. So costs that are relevant in one situation may not be relevant in another context. Thus, in each decision situation, the manager must examine the data at hand and isolate the relevant cost. The purpose here of this slide is that even though some cost for one situation may become relevant, and the same cost may become irrelevant for the other situation, right? For example, in our car situation, if we drive by car, so in that situation they become relevant because you have to pay maintenance per mile, you have to pay there's going to be depreciation per mile, right? And also the gasoline per mile as well. But in other situation like train, so those all become irrelevant because you don't have any option, you are just choosing the train. Right now we are just talking about the train, there is no other option, so then all other things becomes irrelevant if you have decided to go to buy train, right? So that is just the crux of that cost for like the crux is that each situation is different and manager must go through with the two-step process of identifying relevant costing.